Now let's bring in our panel. Solis's Dan Greenhouse, along with CNBC contributor, Capital Area Planning's Malcolm Ethridge. Good to have you, Malcolm. I'll come to you first. I mean, you may have been a little early, but you've been thinking that software, some of these bargains, if you want to call it that, or values, were too good to pass up.
Yeah, I think you're right. I got in trouble for saying you basically can't fall off of the floor, and then the floor fell some more. But I think that the professor's comments pair greatly with Krinsky in the sense that it's creating this setup where the market really just wants to go higher, and it's finding opportunities within any conversation or comment coming out of the White House that doesn't say tensions are going to escalate from here. It's taking that to be good news that things are getting constructive, they're winding down there, and we can get back to business as usual. And so what that means is we've got to now go bargain hunting and find the opportunities within the market that we kind of turned our backs on or started turning our backs on as early as October of last year. Hence the reason why tech is leading the way each time we get these days with these really big swings where it looks like good news is coming. And I think specifically within software, it's obvious that that's where the biggest bargains are, as long as you're convinced that this existential crisis is not going to wipe out the entire sector as a whole. And it's just some companies that are going to get taken out, and others that are already large will probably just get larger as a result. If you look at what happened following the 2008 financial crisis and the banks that no longer exist versus the ones that still do and got significantly bigger, I think that's probably more likely what we're going to see go from here.
Yeah. Dan, I mean, you got to try hard to tell me, I suppose, that software is going to have this comeback and somehow the market's going to be a negative. I mean, this is what people were waiting for, right?
I agree. If you were going to get back into something, it was going to be arguably the hardest hit sector because, to use the phrase, it was probably a coiled spring. You look at the valuation retracement that was done either on an absolute basis or relative to the broader market, and it was quite substantial, indicative of previous bottoms, although obviously you can go further or less depending on a given scenario. So yeah, in that sense, it's not surprising. And yeah, it's going to be very difficult for the market to move higher without tech in general. I would argue you don't necessarily need many of the software names, just some of the larger names. But I mean, listen, the broader market is basically at a high, and these names are still down significantly. So it does reinforce the idea that you don't need them. They are, however, a nice to have.
I would suppose, though, Malcolm, as on Friday, for example, you had the SMH hit a 52-week high. At the same time, the IGV software was hitting a 52-week low. If you're going to ride a little wave here of a comeback in software, and we're suggesting, well, that's got to be great for the market, if and only if semis don't break down. I mean, you can't have that because they're such an integral part of this overall AI story to begin with, right?
Yeah, I think you're spot on. I think it's dangerous if we get to a place where the semis disappoint come this earnings period, simply because 3 out of the 10 biggest inputs into the S&P's earnings for this year are going to be Micron, Broadcom, and NVIDIA. And if those 3 companies put up really strong earnings, which we all imagine they will, that's even going to paper over any companies that report earnings or guidance that's less than stellar because of higher input costs related to fuel. And so I think that it's really important that the semis hold up their end of the bargain, but I think we also are in agreement that we expect that the semis will hold up their end of the bargain.
Dan, there's also
and Scott, that's sort.
Yeah, go ahead.
I was going to say that's sort of my point about the larger names, NVIDIA, Micron, et cetera, being so important to earnings season. Those names, I don't want to use the phrase dwarf for the word dwarf, but they dwarf the importance of many of the software names. Semis are far more consequential to the broader market, obviously.
This newfound momentum feels real in tech. Jeffries today says tech momentum just had its strongest 10-day move in 25 years, the best week since COVID-19 vaccine was released, and that happened in December of 2020. Torsten Slok of Apollo, Dan, says tech valuations now are back to the pre-AI boom levels that we've compressed from 40 times to 20 times. People are hanging on to that as a principal part of the tech bullish story now.
Yeah, and that was the point I made earlier about the valuation retracement being so substantial. I don't want to say these are value names in a lot of respects, but they certainly are far less growthier than they used to be. But I would also add that there's a lot of sectors doing a lot of work here, not just tech. Obviously, the financials, a lot of the banks, the stock charts look very, very good. Obviously, Goldman reported this morning down a bit, but that's not a bad-looking chart. And then the big important ones like Citigroup and JP Morgan, et cetera. So there's a lot of stuff doing a lot of work here, but for the market to break out, those larger tech names are obviously going to be consequential. I would just note, at the risk of being the party pooper, you still have a fair bit of uncertainty coming out of the Middle East and the Strait. And so this isn't a done deal, despite what the broader equity market seems to be saying.
No, that's a fair point, quite obviously. And Malcolm, I mentioned this on halftime today, that I'm sure some had been listening to conversations that sounded overly bullish in the face of what still appears to be a large amount of unknown. And I don't know if you think there's some degree of complacency, assuming that everything is just going to work out fine, or that even if it doesn't, the earnings story and the economic story here in the U.S. is just going to trump everything for the time being.
Yeah, I do think we're a little bit too complacent. We're a little bit too positive on that coiled spring and the assumption that there will be a resolution reached in the Middle East sooner than later. But I think that also helps to tell the story for why tech is so desirable right now. Because if you're looking for a sector or one of a small number of sectors that are less impacted by oil price shocks, that are less impacted by conflict in the Middle East, is going to be tech, right? These software companies have operating leverage that doesn't depend on a ton of inputs other than just human labor, human capital. And so I think that is also what helps to make this an attractive place to be placing your bets for if and when we do get the all clear.